I am
That's
loving
the hardest. That is the
that.
hardest intro I've ever. That was hard.
That intro.
I'm not saying that's the coolest thing that's ever happened. That was harder than I thought. I didn't even know it was going to happen, and it just dun dun.
That intro went hard, and shout out
somebody was on their
to
piano just getting it.
shout out to my man Tone for making that bad boy happen. Welcome in to today's show.
Y'all.
We got a great episode of Money Moves for you guys with myself, Matty A, your co-host, Mr. Ryan Breedwell. We are getting just dumped on in California right now with rain, snow, and I'm not complaining. I mean, the hotel is getting, it looks like a winter wonderland up in Lake Tahoe, which will be great for business, but it's not fun when you're trying to operate a hotel in conditions, whiteout blizzard conditions like they are today. So that's been fun, but we got a great episode for you guys where, of course, we talk all things stocks, real estate investing, and personal finance to help you on your wealth building journey to $1 million and beyond. We've got some interesting housing data that has come out this week. We're going to talk about the winners and losers from all the housing reports, and consumer confidence data just dropped today. Is it up? Is it down? We're going to get Mr. Breedwell's take on the stock market. And is it actually better than it looks and feels right now? Or is it worse? And do we have more gloom and doom ahead? We are going to be covering it all today. I want to start out with this, Mr. Breedwell. I got a question for you.
You got it.
So obviously we know the last 18 months, a lot of asset classes have been getting, hit, some harder than others. And I saw a report released today that one asset class has outperformed returns from stocks and cryptocurrencies. Curious if you know what asset class I'm talking about.
I could cheat and say that I do because you already told me. But, I
loved your original answer.
I wasn't surprised. What did I say?
You said
I said eggs.
You said eggs, orange juice.
I think eggs and orange juice probably outperform both, honestly.
Those assets are definitely up higher than the ones that we're talking about. Nearly all asset classes are down so far over the past 18 months, but the market for second-hand luxury watches have outperformed stocks and crypto, if you can believe it.
I can believe that. Because you have to remember, people are blowing a lot of the money they made prior, and they can't afford the original. So the resale on those watches is great. A lot of times they appreciate, so you can buy them for a price and sell them for a higher price. That's a pretty good. It's like buying a house. It's pretty good.
I mean, it was the secondary market that ultimately a lot of those profits were realized in. So interesting to see how, certain assets, right? And I think I'm curious on your thoughts on alternative asset classes and kind of the rise of alternative asset classes based on culture, based on consumerism that have really kind of, I guess, developed or blossomed over the last decade. Were these types of asset classes always around and we just didn't know about them, or have new ones come onto the scene and kind of has, social media, mainstream, news and really kind of culture and society created more of a demand for these types of asset classes?
I don't know what that used to be called, but it wasn't called alternatives. I can't remember the name of the investment class it used to be called prior to alternatives, but they have been around for quite some time. The popularity in them had not gotten to the level where it's at today. And I just think people's when you have the advent of the internet and then people get the data level that they get now, people have a better understanding of those asset classes and understand that they can derive yield and income from them in a way that you can't, like normal assets that people invest in, which is just based on annualized return.
Yeah.
So I think that is why they've become very popular. I'm not a huge fan of like the apps. They're just not as good as having like I have in most of my portfolios, my non-stock portfolios. If I used funds, we'll throw some alternative mutual funds in there from BlackRock. Normally have like between 4 and 6% of the portfolio there, and it's just better than cash, and it's not a bond. and
Mm-hmm.
it's not as correlated to the stock market, and they tend to have large distributions on small amounts of money. So alternative asset classes, I think, are really key to a diversified portfolio, because if you don't have them, your correlation to the stock market or the market as a whole on the upside and the downside is you're too correlated. If the S&P goes down by 100 or by 50%, you don't want to go down by 50. If it goes up by 10, you don't want to only go up by 6. So it's trying to find that balance, and alternatives can help provide not necessarily annualized rate of return. Some can, but so what they can do is help with the total return by giving you a 5, 6, 7, 8, 10, 12+% yield on that asset
Mm-hmm.
while it's in a semi-safe place. Just in a very, a lot of times the stuff people invest in is like more sophisticated. It's not just, hey, I own a share of Hershey or a share of Microsoft. Hey, I'm putting my money into the refinancement of a shipyard. So that's a lot more of a complicated thing to do. And there's funds that are available. And I really like the BlackRock funds that we use that help people get access to that, but in a way that's liquid. If we need to get out of it, I can just sell the mutual fund. So the mutual fund is, really got their, toes in it and fingers in it. And that's one of the advantages of like doing syndication work on some of the deals that you give to our people that are subscribed, the accredited investors. It just gives them an opportunity to not necessarily do the work, but get a lot of the lion's share of the rate of return on the asset class without having to have the professionalism or know how to do it. So alternatives are great. I think that if you don't have alternatives, it's a great idea to add to your portfolio. Just not like you shouldn't put 100% of your money into an alternative. It's an alternative investment, meaning you should have a basis before you go into stuff like that. But they're great.
Yeah, I mean, I think that there's been so many that have kind of come onto the scene over the last few years, and obviously with technology becoming more advanced and kind of creating a bridge for people to cross and engage in these asset classes, we've seen the rise of them become a little bit more popular, especially right in some of these more fringe assets, right? I mean, you've got investing in spirits, you've got investing in, watches, you've got, diamonds, you've got wine, all kinds of different things now that people are finding ways to store money, have it be something that's fun, generate some returns and yields. While, of course, I think you still got to be careful around one, like you said, they're alternatives for a reason. They come with their own set of risks. And at the same time, right, suitability wise, some are you're locked in a little bit longer. Some are, more liquid. So making sure that you understand what kind of alternatives you're investing in. But I think it's a fun way to kind of get out of, sometimes when people, I feel like, kind of get the itch of like the boring real estate investment, the boring stocks and bonds, right? It is a cool way to kind of diversify a little bit and have it be something that's new and fun and may pair with a passion or something that you're, looking to get more involved in, and still find a way to generate some returns and make investing, right, a little bit sexy and a little bit fun. But as you and I both know, right, going back to the foundation of investing, having a plan is usually going to be something that's heavily allocated in your, financial markets, in real estate, layering in some insurances, and then obviously, having some of those playful, smaller buckets that you can play in. So before we dig into what you're seeing in the stock market, I know a lot of people are feeling a little bit down, a little bit blue. I know you are on the stock market, and, the data that we've been seeing out, we're going to, get your take on sifting through some of that data and really get into, the core of how bad is the market? What are we going to see, in the next few months, and ultimately, hopefully, the sentiment for the entire year. And before we dig into that, I just want to make sure that the people who are, new to the podcast and haven't taken advantage of the resources and all the things that we offer our Millionaire Mindcast family and listeners, whether it's a free financial X-ray with you and your team, which consists of,
we will take a look at your current investments, insurance, all that kind of stuff, aggregate it together, go over kind of some holes that we might find in the plan, make some recommendations on to improve that. And if you want to implement those recommendations, we'll help you do that. Generally speaking, we can help most people improve their bottom line.
And so if you guys want to take advantage of that or engage with Ryan and his team, text the word XRAY to 844-447-1555. And for those of you who are accredited investors and investors in general that, want to know more about different syndication and investment opportunities, whether it's in businesses like the Green Coffee Company that we've been raising capital for, whether it's for apartment building syndications that we've done in the past, laundromats and different businesses, or got some exciting stuff coming up here on one particular alternative investment that I'm involved in that we'll be sharing out here relatively soon. Just text the word deals to 844-447-1555. That'll get you on my credit investor list. And we have all kinds of other cool resources and things for you guys to check out at millionairemindcast.com. So be sure to check out the website as well. But let's dive into what we've been seeing over the last week and really, what feels like after the Fed shared their sentiments on the market, some of their concerns. We had the discussion last week, 50 bips sounds outrageous. That'd be crazy aggressive and very concerning. We're more so in the camp of a 25, basis point rate hike on the next meeting. How does the market respond to that? And ultimately, is that what we're going to see from your perspective?
Yeah, I was hoping that we would get a pause earlier than I think we are. So now I'm going to have to revise that. Like I was saying, I believe last week, 25 basis points is likely going to be the rate hike at the next two meetings. So this one coming up and the one after that. And it's just because the data that a lot of the shelter data that we're getting is just lagging and is a lagging indicator. And so it's taking time for that to catch up and show kind of the true scenario where we're at with inflation. There are things that are more expensive. Consumers are feeling the stickiness of inflation right now in all sorts of areas. But overall, the leading indicators and the leading economic data, that is meaning that it's more forward-looking and present data, is saying that inflation is not only under control, but continuing to go down. And that was indicated today again by the Case-Shiller price index, being down to 4.8% on an expected 5.8, which the 5.8 would have been a drop from the 6.4% last month. So that type of stuff is shelter data is honestly what's hurting us the most right now. That is the number one thing holding kind of the economy back. I think we're going to be a range bound probably for a while because of that. But I'm kind of still, even though the interest rates are where they're at, I am 100% still sticking to my guns that we bottomed out in October, started a new bull market here in November of 2022. They generally take 4 to 6 months, probably 6 months on this cycle to really get roaring because people are going to get rotated. Institutions are going to take positions, options, all that kind of stuff. And right around May, I think that would be, we should see the stock market start to really catch some legs and start moving forward in a positive way. I think we'll get an indication sometime in July that they'll start pausing interest rates, and they're probably going to cut interest rates sometime between October and December. I do think one of the funny things is people hate to listen to analysts and investors when the market's going good, but when the market's going bad, people like to listen to them. So we have like Bank of America, and I even believe Goldman Sachs saying that they believe rate cuts are going to now be in Q1 of 2024. And these were the same banks that in 2007 and 2008 were telling you that they weren't over leveraged. So you got to balance. You have to balance what you're hearing from the same people that told you that, everything was okay when it wasn't, are now trying to tell you that things aren't okay, and they probably are. So that's my position. I'm sticking to it. Definitely going to be choppy market for the next few months, but really still looking good. I still think as of right now to have a good setup to be potentially in that 4,400 zone on the S&P by the end of the year.
So I would be failing our listeners if we didn't go back to your favorite bull or your favorite bear. It feels like the bull market that we've been kind of feeling pent up and is coming has kind of had some false starts. And to bring up Peter Schiff, his last statement that you can see here, Tone, on the screen, the January PCE confirms his, of course, bear sentiment that this disinflationary environment that many people have been talking about and continue to, use to point to the future of this bull market coming around the corner, is that disinflation is over. The inflation curve has turned upward again, and soon year-over-year numbers will be hitting new cycle highs. Not only are the PCE numbers for January hotter than expected, but month over month and year-over-year, they are sequentially hotter than December. So with this data that has come out, what's your argument to that, being that I think we both would probably agree the data is very lagging and maybe isn't necessarily representative of what the current climate is today, but at the same time, are we in an inflationary environment again? And has the pendulum swung back in that direction?
So again, I'll kind of say the same thing to start this. Like I said about the banks, Peter Schiff has just not really had a track record of ever being right. So I'll start by saying that. And if you'd like, just go look up his funds. They suck. Secondly to that, I don't agree with that. And there's a lot of reasons because you can cherry pick one piece of data and say that that's the be all end all, the hallmark, but PCE is not the hallmark data point to indicate anything is one way or the other. I saw people posting charts on Twitter on the 30-day and the 10-day moving average. And I was like, what the actual fuck is this? Nobody charts the 10-day and the 30-day moving average at all. But you can do that and admit the chart will align with your story. My point being, I think there's a lot of people trying to find a narrative so they can sound right, because nobody is brave enough to just say something and be wrong, because for some reason people have to be in this stock market, this casino that we have, and somehow always pick the winning, always get the winning hand dealt to them, and always pick the winning machine, and always make the right decisions. And that's just not how it works in investing. So that, and painting that false narrative for people that they should expect that, and that, this is what the wealthy do, and this is, when you're doing it right, you don't ever take losses. Peter Schiff has been blowing it for years. His funds average less than 3.5%. I mean, long term. I mean, that's garbage. You could close your eyes and buy a fucking 20-year treasury bill and average more than that. So it's really not hard. So excuse my language here. It just kind of is comical to me when you just have a name like, oh, it's Peter Schiff. Who's Peter Schiff? I mean, who's Peter Schiff? So again, I'll get back to it. No, yield curve is actually looking good and better. When we do see bonds kind of do their rallies, and they're rallying in the right way, short-term debt is starting to, even though it did tick up pretty aggressively over the past 45 days, it's starting to pull back, and then long-term debt is starting to have higher yields. So today we saw the 5-year and the 2-year pull down on yields, and the 10-year and the 30-year pull up on yield. That's good. That we want people to be paid more for longer term debt than shorter term debt. So that's good on the yield curve. Conversely, almost 46% of the stocks trading in the stock market as a whole were in the green today. Indexes were in the red, but the indexes are not showing the full picture. And as I said, normally when we go into a brand new bull market, I've said this multiple times, the starting area is going to be small caps. And if you look at a heat map of where there was money being made today, well, I'll give you a hint: small cap growth. And in fact, the average rate of return on small cap growth today was 36 basis points, 0.36%. The average loss on value and blend small cap was less than 1 basis point. So those areas of the market are still doing good while the overall market is not doing good. And I just think people are rotating out of certain names: energy, industrials, healthcare, defensive equity names that generally people go into when the market's choppy, like where people were last year and where people were piling into at the beginning of this year and the end of last year. We also had a little bit of the January effect where we had a really big run up in stocks, kind of a drunken rally on some garbage names that didn't really need to be going up, but did go up. And that kind of lulled people into the market, kind of into a bull trap right there. So those little things in the short term are causing some pullback. but we're still on the long-term trajectory, on the long-term trend line. We're still above it, and we're likely going to bounce off of that here somewhere around the 39 to high 38s and continue to have another little bit of a rally. And I think that's what we're going to do for the next few months. We're going to be somewhat range bound. And so dollar cost averaging, putting money into the stock market consistently over these next 6 months is going to be very important. And really, people who've been putting money into the stock market over the past 15 months and continuously have been doing that are going to be the ones that fare the best when this rally really sets in and starts to go, because all those people are doing are buying assets, averaging their internal costs down, and getting ready to kind of light the dry powder. It's just sitting there pouring powder into this keg and saying, how much can I fill it up with before I light it?
I'm over here rubbing my hands because it's kind of like the way I look at it is, in the winter, it gets a little cold and you got to do whatever you got to do to kind of, stay warm in the meantime. But when the furnace kicks back on and the fire starts blazing, you're feeling good.
It's a beautiful time when I had people, I remember from 2020 to 2021 making triple digit returns in ETFs, which is just equity ETFs, which is ridiculous. That's not normal. So I don't think we're going to get a rally like that maybe in 1 year. But when you have the stock market go up and continuously go, people are going to absolutely flow back into the market like it's a crack rock, and their name is Hunter Biden.
I knew you were going there. I was waiting. For you.
So that is that's what I'm excited for. I'm excited for that. We're like I said, about to go into the 16th month of this bear market. It's been a longer than expected or anticipated by anybody market, generally because the technicals are getting thrown off by lots of stuff that we haven't dealt with before. But
there's so many different variables this go around that I think were hard to account for based on historical patterns and data.
Yep.
And as the dust continues to settle, right, maybe it goes on a little bit longer than any of us would like or maybe expected. But I think this isn't going to be for the newer investors and really just for the seasoned and savvy investors, because I think I need to hear this all the time myself, is it's not going to be the last time we face another challenging market like this that tries your patience, that tests your resolve and your grit to power through, some of the mental, physical, financial burdens that are in front of us at certain seasons of our life. And that's where just having the plan and the discipline to fall back on your default, habits that you committed to and agreed in the beginning when you started doing them were for the best in terms of your long-term health, your long-term financial success, right? You have to really remove a lot of those emotions and remind yourself that this is the journey. I loved what Morgan Housel said in his book, The Psychology of Money, which is volatility is the price you pay for getting wealthy. And when you look at all the people who have really not only weathered challenging financial storms and times, but thrived through them or post them and continued to pass on generational wealth. I mean, some of the wealthiest families, some of the wealthiest businesses, they weren't immune to the financial and economic and world and global challenges that were going on at, over the last however many years of that economic system, right? And they found a way to push through them, and they found a way to ultimately win through them. And those are the things that I have to constantly remind myself of, no matter how challenging times get or how emotionally uneasy my stomach feels by doing some of the things that feel counterintuitive to the emotion in that moment. When you look back in the rearview mirror and you're like, man, thank God I did that. I didn't follow, my emotion. That ended up being something that was a great financial decision over the long term. That's where having a real plan, good counsel around you, and being just involved in the right conversations can get you out of your own head from making some, mistakes or decisions that may not serve you based on the emotion driving versus going, okay, these people have the same fears, that I do, but they are following through with the commitments and the plans that they decided were best aligned with their goals long term. And I think that's something that I constantly have to remind myself, especially in times like right now.
Yeah, I mean, a good example of what you just said is like a company like GE, was down to almost $30 a share from being $180 long-term dividend paying, huge part of the Dow, removed from the Dow. Now it's an S&P component. That company had to go through some crazy headwinds, completely rebrand. They have to do GE Healthcare now. They have to spin off all these companies. But instead of folding under pressure, they've revamped themselves. And now I think they're trading at, I don't know, $80, $90 a share. So a 300% rate of return since that downfall in 2020. And they're on their way back to being the company they were and now have potential to be. And it would take that bad, hit on the chin to get to where they're going to get to. But they had a choice whether to fold and go through bankruptcy and sell their assets off, or completely reorganize and restructure their company and keep that brand going. And that's what they chose to do. So to your point, that is exactly what you have to do.
Well, if you were looking for some exciting opportunities and massively distressed and discounted properties in the real estate space, you're going to have to wait a little bit longer. A lot of data has come out this week regarding the overall strength of the single family housing market, still in spite of a lot of the headwinds that are, pushing back what was an insanely hot real estate market. But this last week, pending home sales increased 8.1%. Data released for the month of January. It's still down 24.1% year over year. But still, overall, this is, a pretty good sign, an indicator forward looking of home sales based on contract signings. And obviously, I think part of that was due to some rate easing where people were getting off the fence. But overall, rates still aren't that great. They remain much higher than they were to begin the month, with an average lender moving up from 6% or 5.99% to 6.78% since February 2nd. The 30-year fix right now is, I think, at 6.78%, which is still pretty crazy. But when you got inventory, which this last week of inventory data decreased 1.6% week over week. So when you got inventory and supply still so low, and you still got a relatively decent amount of equity in the marketplace that's still trying to find a way, to find a home. Obviously, for a lot of people, right, a lot of that free dry powder is going to go into their primary residence. Mm-hmm. Inventory is up, compared to the same week in 2022. But it is down almost 48% compared to the same week in 2019. So we still have, a long ways to go for inventory to catch up. And when you see, pending home sales data like that, that's telling you demand is strong, especially if it's increasing. So I think that's going to be something that, will be important to pay attention to on the pending home sales and, where rates end up, because, when the Fed sees this kind of data, I mean, what do you think, Jerome Powell and the Federal Open Markets Committees are saying right now when they see this kind of housing data and how they're deciding what do they do with rates going forward?
They're going to say that their suspicions are correct and they need to continue raising rates. And I don't fault them for that. Based on the metrics they're using, I just think the metrics they're using are incorrect. And if they use different metrics, we would be in a different spot with the economy right now.
Well, yeah, I'm curious because I think that's an interesting conversation, right? Around what data or metrics could they maybe be adjusting to based on new times, new landscapes, new access to technology that could
remove OER in the shelter data, and they need to make Case-Shiller a price index a part of the housing data. I mean, those two things probably fix the problem completely.
Yeah, that's an interesting thought, right? Of like, why don't they?
It's almost like why is a CPI wage index tied so much to oil, and then that has they use that for retirees. Retirees don't use that much oil on as much as somebody that's working on a day-to-day basis. So why would that be tied so much to their cost of living adjustments on their Social Security payments?
Yeah,
doesn't really make a ton of sense, does it? That's just the way, unfortunately, they do it sometimes. And so there's a lot of things that I would say are long in the tooth that need some looking at, but
some retooling.
it makes with the amount of technology and how fast we can get data today, while we're looking back at stuff that's 90 days, 140, 150 days old to make decisions for today. That's just absolutely so stupid to me.
Well, it'll be interesting to see what pending home sales do in the coming months. I mean, year over year, pending transactions dropped almost 25%. So what they are doing is working in some capacity, but if it starts trending in the wrong direction, it's going to be interesting to see how they play this interest rate game. Home values this last week, both the Case-Shiller House Price Index and the Federal Housing Finance Agency for December, that data was released. So the S&P CoreLogic Case-Shiller National Home Price Index, covering all 9 U.S. Census divisions broken up across the U.S., reported a 5.8% annual gain in December, which is down from 7.6% in the previous month. So coming down a little bit. The month-over-month decrease in the seasonally adjusted Case-Shiller National Index was at negative 0.35%, 6 consecutive month-over-month decrease, a slightly larger decrease than in November, and the largest declines were in Las Vegas at negative 1.5%, Phoenix negative 1.3%, and Portland negative 1.3%, which were markets that really saw some aggressive growth during the pandemic, but are starting to slow down. San Francisco's fallen 12.7% from the peak in May of 2022, and really was the first Case-Shiller city with a year-over-year decline of negative 4.2%. Seattle is now down at negative 1.8% year over year, which I find as, a validating point, I guess, for the Fed. Some of these larger, metropolises that were just insanely hot, crazy demand are starting to decline and really kind of catch up a little bit, which is ultimately what they want to see. The ones that fared the best, Miami, Tampa, and Atlanta, reported the highest year-over-year gains among the 20 cities in December. Miami led the way at 15.9% year-over-year price increase. People want that food, that sun, that sand. Followed by Tampa in second with a 13.9% increase, and Atlanta in third, 10.4% increase. So interesting to see, what the single-family housing market is doing. But what I can tell you is there is a little bit of a storm brewing in commercial real estate. And that's really where I'm interested in paying the most attention to. Obviously, if you're a single family investor, tracking the data that is coming out in the housing reports is very important. And if you're a commercial real estate investor, we're seeing when I start to see the big boys and girls skin their knees and kind of do a little bit of a face plant, we're seeing some of the top landlords across the country and some of the largest commercial square footage in the country defaulting on their loan payments on the buildings that they own. So that's something to be paying attention to. And I'm already seeing some more opportunities that actually are penciling and starting to make some sense. I still think we got a long ways to go for commercial real estate, especially with certain asset classes. But Freddie Mac mortgage reported serious delinquency rate unchanged in January. Fannie Mae noted a decrease slightly. Single family serious delinquency rate in January was 0.66%, unchanged from 0.66%. And then in Freddie, this is where it caught my eye. Multifamily delinquency. Note that multifamily from Freddie Mac report, multifamily delinquencies have been increased slightly and were at 0.12% in January, up from 0.07% in January of 2022. So I think it's going to be interesting to pay attention to what happens with multifamily, because that one was probably the hottest. And I think that will be interesting and telling that if those numbers start to increase in a negative, context for that asset class, or at least start softening, you're for sure going to see all the other areas, because that one was the most insulated out of all the asset classes due to the pandemic, shelter, that kind of stuff. But that being said, asking rents are falling, and this is something that I think will tie back into CPI and PCE, which will hopefully, forecast and project out what kind of trends we might be seeing in, the commercial and housing spaces. I do think that there's going to be an insane opportunity for readaptive use in commercial spaces. I mean, I'm looking at one right outside the studio right now, which is a big vacant, empty Kmart building. And you're going to see a lot of big retail anchors.
Yeah, what?
You're going to see a lot of
Somebody
big.
buy that shit.
You're going to see
That
a
thing
lot
is
of
just,
big,
that's the donut. That's where people do donuts on Friday nights.
Yeah. I mean, I hear them outside my office all the time. But
Yeah.
you're going to see Kmart's. You're going to see big office buildings. You're going to see,
Oh,
there's massive amounts of vacancies right now in San Francisco in office. So I think, you're going to see people get creative with readaptive use in certain commercial assets that are going to make them a fortune and be very successful. But that doesn't mean that if you're not a big institutional player, you can't take advantage of the commercial opportunities that are out there and available, and are going to be coming more plentiful in the coming months. So getting clear on your criteria, getting your banking relationships dialed in, looking at creative seller financing options and how you can make deals pencil and make a win-win in the short term while you restabilize assets, then go to refinance them and get permanent debt. I think it's going to be an exciting time for investors over the next few years, and definitely want to make sure you take advantage of it. And if you're not one of those people that actively wants to be out doing it, then join my accredited investor list and I'll get some deals in front of you by texting the word deals to 844-447-1555. With that being said, we will keep you guys in the loop on all things stocks, real estate investing, and personal finance. And if you are not subscribed to the channel, be sure to hit that subscribe button so you never miss another episode. All we ask is that if you guys enjoy the content, the data that we share and scrape up for you guys each and every week, take 2 minutes, leave a 5-star review on iTunes. It would mean the world to us. Don't forget to take advantage of your free financial X-ray on your portfolio by texting the word X-ray to 844-447-1555. Come on over. Mr. Breedwell says he don't bite. And with that being said, keep investing in yourself and your wealth on your march to $1 million and beyond. We'll see you guys in next week's episode. Cheers.
Cheers.